What's up, friends? Welcome to Web3 Academy, a place for entrepreneurs, creators, and marketers to explore and learn how to use Web3 to transform business models and create thriving communities. Enjoy this next episode. GM, welcome, friends, back to another episode of Web3 Academy podcast. I'm here by myself to talk about why blockchains are valuable. Right? There's a lot of talk about this technology and what's going on here and all the NFTs and things that are being built on top of it. But the fundamentals here, like the foundation, why does this stuff even matter? What is it that blockchains provide? What is the product of the service that blockchains provide that are making people actually pay to use this stuff? Why don't we just use normal centralized databases? Why are we spending insane fees on Ethereum or fees anywhere on any blockchain to use this stuff? And that's what we're going to talk about here in this episode today. So I'm actually going to read an article that was written by a member of the Web3 Academy community. This is the first time we have done this, and I'm super excited that we are seeing contributors from the community. One of the members named Sam Andrew, who is in our Discord, is a writer, and he's actually he's a reformed hedge fund investor turned crypto researcher, writer, and an investor overall. He spent 10 years at a $22 billion New York City-based hedge fund, and now he's moving full on into crypto. And we saw some of his writings, and we were super impressed. And it was very in line with the things that we teach. And so Sam has thankfully given us his article to host at Web3 Academy. And so we've launched it in our newsletter. And then I'm going to read it here on this podcast. We also have Sam coming on the podcast in the same week, so we can interview him and dive deeper into some of the things that he wrote about here that you're about to learn. So, I'm excited to share this because often in our roll-up and in our interviews, I try to get across the benefits here of blockchain. And so it's about time we just fully focus on it and let you understand and learn the true foundation of what's going on here. Finally, before I get into it, if you are also a writer, or if you have something cool that you want to share, maybe you've never written before, but you have some great thoughts, we ask that you write for Web3 Academy. All you have to do is there's a link in the show notes below, and there's a link there where you can apply. And basically all you need to do is write something. And so long as it provides value to entrepreneurs, creators, and marketers trying to stay on the forefront of Web3, then please apply and share that with us. If we like it, we will do exactly what we're doing here. We'll post it on our newsletter so you get all the links back to your site and to your Twitter, et cetera, or wherever. And we'll do a podcast just like this. And maybe we'll even get you on the podcast for an interview. So we're about to get into this here. Again, this was written by Sam Andrew. You can follow him on Twitter at Samuel M. Andrew. And that's it. He also writes his own newsletter called Sam's Crypto Musings. So samuelandrew.substack.com. Again, the links are in the show notes. So why are blockchains valuable? Well, amid the hype, innovation, and enormous wealth creation, this simple yet profound question eluded me. This is Sam saying this, of course. Advocates proselytize that blockchains will disrupt every industry. Blockchains could revolutionize traditional finance, disrupt the art world, and create new forms of monetization and record keeping. Potential use cases are seemingly endless. This is one of the things we try to share on our podcast is all of the different potential use cases here of Web3 and blockchain. So instead of assessing that blockchains could be valuable if it does X or when it achieves Y, I propose assessing features of blockchains that are inherently valuable. I posit that blockchains are valuable because of 4 features. 1, decentralized. 2, functional. 3, composable. And 4, native economics. These features make blockchains the most fertile ground for innovation, spurring an innovation supercycle. They are present in programmable blockchains, which are the focus of this piece. Their presence varies in degrees across different programmable blockchains. We talk about this a lot as well. For example, some are more decentralized than others. These features are not all present in Bitcoin, which is not programmable and not the focus of this piece. So what we're talking about here is actually smart contract platforms. So things like Ethereum and Solana and Avalanche, and the list goes on and on and on. So decentralized. Blockchains are decentralized because they're not controlled by a central authority. Decentralization is a feature unique to blockchains due to their innovation in incentives and governance. Okay, so trust guarantees foster cooperative networks. Decentralization is valuable because it creates a trust guarantee that no human operated system can, right? The risk of a business becoming obsolete by a change in operating procedure of a centralized platform a business is relying on, known as deplatforming, is eliminated on a blockchain because no entity can change how the blockchain operates, right? This is the problem when you build, let's say, games on Facebook, or you integrate an API or something into Twitter. As soon as they change the rules, well, this impacts your business completely. If you run your business on YouTube and that's where you speak to your audience and they block you, your entire business is at risk, right? This is the problem of centralized organizations or centralized platforms. So a trust guarantee is valuable to developers because they can build their decentralized applications or dApps with the guarantee that the blockchain network dApps are built on will not change, right? The same cannot be said for centralized networks like Microsoft and Meta and Google and Apple and Amazon have a checkered history changing how their platforms operate to favor themselves at the expense of businesses who built applications on their centralized networks. Okay, so for example, Microsoft marginalized Netscape with Internet Explorer. Meta marginalized Zynga with its own games. Google marginalized Yelp by introducing its own revenues. And Amazon marginalized independent Amazon retailers with Amazon Basic. Decentralized organizations care about decentralized organizations. They don't care about those who are building on it and the users who are using it. They care about money. They care about profits because that's who their shareholders are. That's who they report to. So centralized networks have fraught relationships with their constituents. As the chart below, popularized by Chris Dixon, general partner at A16Z, illustrates, in the beginning, a network rapidly grows by cooperating with developers, creators, and businesses to build its network. We see this all the time. Once the network matures and moves toward the top of the S-curve, as its user growth slows, it pivots to extracting value from its users. Cooperation with the network's complements turns into competition as the centralized network infringes on the complements businesses to extract value for itself. Decentralized networks foster sustained cooperative relationships with users, developers, creators, and businesses. The trust guarantee prevents a bait and switch that centralized networks are renowned for. So basically what we're trying to explain here, and there's some graphs, but unless you're reading it or watching on YouTube, you might not understand what I'm talking about. Basically, there's an S-curve where in the very beginning, these companies work well with all of their partners and users, et cetera. And this attracts a lot of people on board, right? And it creates growth. Eventually that growth stops. There's not much more they can do. And so instead of just trying to make it a better user experience or provide more value, they instead try to extract as much value as they possibly can from those who are using it while they are still the it thing, right? But blockchains are different because those who use it also own it, right? Those who use Ethereum, they own ETH. And so the incentive models are very different in a blockchain that is decentralized and owned by the community versus a centralized organization. Self-custodied assets create better user experiences. Decentralization enables self-custody of assets. The user directly controls and owns their assets in this way. The owner is not relying on a third-party authority controlling and dictating what they can do with their assets. Okay, centralized networks are predicated on the assets being controlled and in some cases owned by the governing authority. In decentralized networks, your assets truly are your assets and not someone else's liability. Savings at a bank may be your assets, but they are also the bank's liability. The bank controls the size, timing, frequency, and amount of withdrawals and to whom they can be sent. For example, my Canadian bank did not allow me to send my own money to a crypto exchange and levied heavy fees to wire my money to my US account. Online content is also an asset, right? The pictures posted, the tweets tweeted, essays written, and followers cultivated are digital assets. They're created by content producers, but owned by centralized networks. Meta owns all the content across its platforms. Google owns users' search history. Twitter owns all of the tweets. The business model of centralized networks is based on users creating and publishing content for free, while the network monetizes the value created by its users. We are essentially slaves to these centralized organizations. And these tweets and these posts and all of the things that we put on these networks or these applications or these platforms, we should own them because we created them. Yet in this instance, we don't, right? So decentralized networks are valuable because users retain ownership and custody of their assets and are not beholden to third-party authorities dictating terms of use and monetization. For example, users can exchange their assets however they want. And if they leave a platform, they can take their assets with them, including pictures, posts, tweets, blue verified check marks, and followers. In centralized networks, users are the product. In decentralized networks, the user is the owner, paving the way for a better user experience. This is so huge. This is so profound. It's such a big thing that's going to change, probably change the world in a very big way, is finally being able to own things online. And I don't think enough people really grasp this. In the real world, we can actually own something. If I hold up a dollar bill, I own that dollar bill, okay? There is no one that I need to trust to hold on to that dollar bill for me, right? But online in the digital, same with a passport or I don't know, a book or my computer or my headphones, I own these and no one can stop me from selling it, giving it to someone else, doing whatever I want with it. It is mine. I physically own it, okay? Online, that doesn't exist. Everything is trusted through third parties. Everything, your money in your banks, as Sam already alluded to here, your profile and your accounts on Facebook, on Google, on whatever else, your content, everything that you, even when you just want to send money to someone, you have to use Stripe or PayPal or whatever. Regardless, it's all permissioned and it's all owned by someone else. And we have to trust that they will do what we think they're going to do. And for many, that trust gets broken and what we want them to do or what we hope they are going to do does not happen and we have no say. That is the digital world that we live in. Decentralized networks completely changes that. And that's what self-custody is. It is a beautiful, beautiful thing. Okay, so functional. They're not just decentralized. It's not the only thing that this does. They're also functional. And what this means is blockchains provide unparalleled functionality to build applications on because they are programmable, immutable, transparent, and permissionless. Okay, so let's just look at these four categories here, these four functions, and just break them down by description so we understand, and just talk about why this is valuable. Why does this actually matter? So programmable, highly expressive, near Turing, complete programming language, meaning it can run and implement any program. Now, why is this valuable? Well, it creates smart contracts between parties that are guaranteed to execute if predetermined conditions are met. Meaning if I want to send you X amount of ETH, it happens every single time, right? Smart contracts replace laborious fact-checking required for off-chain contracts with guaranteed accuracy and instant execution. Immutable, transaction history cannot be altered. This is huge in a world where we have corrupt and centralized organizations who will lie and change things for the better of themselves. So this ensures, why is this valuable? Well, it ensures the sanctity of the blockchain by preventing a bad actor from changing the historical record to their benefit. Transparent, all transactions are visible and verifiable. So why is this valuable? Well, it ensures integrity of the blockchain by allowing anyone to audit historical transactions. Imagine being able to go to Meta or to Google and asking them a question about what they do with user data, or how much they spending on X, or how much they are extracting from their users in revenue. They're not going to tell you the exact amount. Of course not. But we can just see it now. That's the beauty thing of these open, transparent blockchains. Permissionless. I talk about this one all the time. It's actually word of the day for one of last week's weekly roll-up. So anyone with an internet connection can participate without obtaining approval. And why is this valuable? Well, everyone can participate and benefit from the innovation, right? There's a lot of people in the world that are blocked from doing certain things on the internet, right? We think about North Korea and China as big examples. China can't use Facebook and many of the applications we use on the Western side of the world. But if we go deeper, we look at a lot of Middle Eastern countries and African countries that can't use Stripe, right? Or PayPal and the things that we use to just buy things on the internet. They don't even have that capacity. So this and this is just money I'm talking about here, but this permissionlessness, I think that's the way you would say it, is a beautiful thing because it means anyone can benefit from this. And that's huge. So combined, this functionality provides more latitude for developers to build applications than centralized networks. Composable. I don't think that we talk about composability enough on Web3 Academy. So I like this one. Composability equals building blocks. Okay. So blockchains are composable, meaning each component can be recombined into another. The output of one can be the input of another. They talk to one another and leverage each other's code and each other's utility. A platform is composable if its existing resources can be used as building blocks and programmed into higher order applications. So quote from Jesse Walden, founder at Variant. So composability is valuable. Composable blockchains are like Lego blocks. Each piece can be combined with any other piece to build. This is a new valuable way of building because one, it's open source. Web 1, when we first built the internet, we tried to build it in an open source manner, but things quickly became closed. So open source, composable blockchains are open source. Everyone must be able to see what the code is in order to develop new code that interacts with it. Open source composability unlocks what has been locked behind firewalls of banks and big tech companies, right? Number 2, efficient development. Composability fosters efficient development because problems are only solved once, right? Non-composable, so centralized networks, are inefficient because engineering talent repeatedly has to solve the same problems. If Google solves a problem, well, Facebook's also got to go solve it because Google's not going to tell Facebook. They're competing, right? Open source composable blockchains allow developers to use what is already built as a building block for something new. Number 3, accelerates innovation. Composability channels talent to new product development, accelerating innovation. Composability allows anyone to take existing programs and build on top of them, unlocking previously unimaginable use cases. And number 4, promotes a cooperative mindset. Centralized networks enforce intellectual property law. They sue one another and lobby for favorable regulation to preserve the competitive advantage. They're walled garden, right? So composable blockchains where the code is public promote cooperation because it's inevitable that their code is leveraged to build higher order applications. The higher order applications are beneficial to the network it's built on because they create new use cases, propelling additional demand for the network. A great example of this is, some of you may have heard of the term DeFi Lego. So back in 2020, we had this sort of DeFi summer, it was called, which is where things just went crazy. Users were coming in, all of a sudden a bunch of these applications we could use. There was a bunch of like yield opportunities, and there was a lot of opportunity to create, to make money. And the reason why this was worked out the way that it did is because for a long time we had basically just had MakerDAO, which was a way for you to take out a loan of DAI, a stable coin, so long as you used your ETH as collateral. And so next, what happened was there was other applications that were built during, before this DeFi summer. So Uniswap, which is where you can exchange tokens, right? You can exchange your ETH for Uni token or Aave token or whatever. And then there was also other lending platforms where you could put other tokens other than just ETH up for collateral, or you could lend them out and gain some interest on it, right? So not taking a loan, but you could gain some interest by lending. And what happened was all of these protocols, because they're all open source, they started building on top of each other. And so let's say you don't have, I don't know, the Uni token, but you wanted to lend that out in Aave. Well, they built in ways where just automatically you go in to do this and it just does the switch for you by using the underlying Uniswap protocol. You didn't have to go over to Uniswap. Aave or whatever other DeFi application you were using at the time could just build over top of it and link into it. It didn't need to create a swap feature because there was already a protocol that has built that, right? This is the idea of these sort of Legos where you sort of piece them together. Once one protocol solves a problem, this example is swapping or lending, you just build on top of it. And now all of a sudden you have lending, you have swapping, and you have whatever feature it is that you're building. And then someone else can build on top of that. And they all benefit from each other. That is the cool composability ecosystem that we're building here with Web3. Number 4 is native economics. So blockchains issue tokens to incentivize behavior, facilitate governance, and enable contributors to capture potential economic upside from creating a valuable network. The creation of digitally native assets in the form of tokens, right, is valuable because for the first time in history, economic value can be seamlessly created, stored, and transferred online. This is that digital ownership, right? Non-custodial. So creating, storing, and transferring economic value online is valuable because it pioneers the ownership economy, an internet native economy where users own the value they participated in creating. It allows creators an unparalleled ability to independently control and monetize their creations. It allows assets to be transferred globally, nearly instantaneously at low cost. Maybe not yet at low cost, but it's coming. The tech is coming, I swear. It is advancing entirely new digital economies. Artists and gamers are examples of new economic activity powered by native tokens. dApps like Audius provide new monetization avenues for disenfranchised musicians. There are 2.6 million active musicians, defined by uploading more than 10 songs, on Spotify, yet only 16,500 or 0.6% earn more than $50,000 per year. And that's due to the high take rates of Spotify. The appeal of Audius, which is kind of the Web3 version, to musicians is they get 90% of music revenue, right? They own their own catalog and they determine how they want to monetize their content. Audius's native token, is used to ensure security of the network by rewarding validators. Artists are rewarded in audio, and users use audio to gain access to gated content. Audius is owned and operated by its artists, its listeners, and network validators. It is governed through ownership stakes in audio. So you think about how that works. Like if you think about a country, right? Let's say the US, okay? They have the US dollar, and companies need to be paid in US dollars. It's legal tenders. Companies have to accept US dollar. Employees need to be paid in US dollar. When you pay your taxes, you have to pay the government back in US dollars, right? This is a whole economy which runs off of the US dollar, right? And so people are, obviously those who use the US dollar want the US to do well. They want to vote and they want to do things because they're incentivized, because all of their life savings, they own real estate in the US. They earn in US dollar. Their savings are probably in US dollars. They probably invest in US companies. So they want the US to do well. They are incentivized for the US to do well because of these economic incentives. Well, this is what we're now able to do online, digitally. And this is what you see with Audius, where they have this own ecosystem, right? The users need to hold audio, the token. The creators need to hold audio, the token. Those who validate the network need to hold audio and earn audio, the token. And so all of the different constituents of this ecosystem are incentivized to help Audius improve and do better. And so maybe they're more incentivized to vote and help figure out how to make this platform better, because ultimately that means their holdings and the things they get paid in is going to go up, right? So they're incentivized to help the platform. That doesn't happen with Facebook or with Spotify. People could give two shits, right? Because they're not earning anything from it. So another example, blockchain video games like Axie Infinity are pioneering play-to-earn gaming models. Gamers buy or rent Axie NFTs to join the game. Axie's native tokens are used for staking, governance, and payment. Gamers can earn tokens by playing the game and spend them in game to create new characters. So you have these burning mechanisms as well as these earning mechanisms. And through exchanges, tokens can be exchanged for other digital assets and fiat currencies. So Axie Infinity is not available on mobile app stores and has painfully complicated process to acquire these Axie NFTs to start playing. Yet it has 1.5 million daily active users. Right now, it's down from, I think it was 3 million back in November, and it generated $4 billion of NFT volumes since March of 2022. So again, people are incentivized to use this game. They're incentivized to improve the game and be involved in the decisions of the game because they have actual real assets and ownership of them. So at this stage, whether or not Audius, Axie Infinity, or other DApp tokens increase in value is not critical. They are examples of how blockchain-powered tokens can create, store, and transfer value natively online, ushering in entirely new digital native economies. In 1997, eBay sold $500 million worth of Beanie Babies. The $5 plush toys soared to thousands of dollars in price and then crashed. Beanie Babies were overhyped fads like many before, and perhaps like NFTs today, but they served a purpose. The Beanie Baby market mania helped build eBay and ultimately online commerce. In its 1998 IPO prospectus, eBay noted a softening in the Beanie Baby market as a risk factor. NFTs like Beanie Babies to eBay are bringing millions of people to a new network. That is what is critical, not the price of a JPEG, right? So some very interesting comparisons there between eBay and Beanie Babies and NFTs. It's very, very true. So all of this, what does this bring? So an innovation super cycle. It's impossible to envision the ways blockchains can innovate, right? When a clunky phone with no keyboard, GPS functionality, and a camera was introduced back in 2008, users didn't know what to do with it, right? Calls dropped, typing without a keyboard didn't work very well. The battery lasted a few hours. The internet connection was poor. But as the connection and functionality improved, free global communication apps like WhatsApp were developed, right? The camera was used to share photos on Instagram. Uber leveraged GPS to order cars and food, right? As more apps were developed, the quality of the smartphone improved, which then allowed for even better apps. More developers and entrepreneurs flocked to the budding ecosystem, and the innovation cycle fed itself, right? So a similar cycle is afoot here with blockchain, only the decentralized, functional, composable, and native economics of programmable blockchain are powering an innovation super cycle, right? The bedrock of the innovation super cycle is the trust guarantee ensured by decentralized blockchains. It creates a cooperative relationship between network constituents. The cooperative relationship secures a safe building environment where entrepreneurs need, not fear, deplatforming. As a result, more developers join the network. The decentralized and functional nature of blockchains leads to more developers joining and building better products. This is the flywheel, right? They grow exponentially by adding more developers, whereas centralized networks only improve at the rate of which the owner improves them. So native economics enables this creation, storage, and transfer of value online seamlessly between network participants. It cements the cooperative relationship and simultaneously new users and entrepreneurial developers conceive derivative products, right? Built on top of existing products. So derivative products bring even more users into the network, leading to more capital, making the network an even more fertile development platform. The innovation super cycle feeds itself, right? This is so key. Is if we just think about everything I just talked about there, a lot of people use blockchains, not a lot of people, but a decent amount of people use blockchains right now, and the experience is not great. And it's hard for us to envision all of the things that may come from this. Just like when the internet first started, it was hard for people to realize. No one would have predicted back. Well, I'm sure there was someone, but not many people would have predicted that back in 1995, I would be speaking to you, sharing a screen and covering this topic through my laptop that you're listening to on Spotify or Apple Podcasts, whatever, as you walk around outside or go for a run, right? Like that would not have been thought of, but the tech developed, right? Internet got faster. Then we got mobile, then we had apps. And so that's what's going to happen here with blockchain. A lot of the things are not super usable right now, especially for the masses, but it's coming. And once it gets faster and cheaper, then things that we can't even think of today are going to be built out. And this is just going to be a flywheel of, as people see this, more users come in and then more developers come in, and it just keeps happening. Okay, so innovation is booming. Blockchains are a hotbed of innovation, attracting billions of dollars of capital and talent. The combined market cap of all programmable blockchains is nearly 500 billion. This was written in March. This is probably lower today because, well, we are in a bear market. That's life. There are 25 programmable blockchains with over $1 billion in market cap. Ethereum is by far the largest with a market cap of 330 billion. I think it's about 220 billion right now, but over 10x the size of the second largest. The combined market cap of all crypto assets is nearly 1.7 trillion. I think it's probably closer to a trillion right now, unfortunately. Innovation and capital has ballooned in 3 main sectors. So we have DeFi, or decentralized finance, right? So this enables a new way to transact globally at scale with near instantaneous settlement and low costs. It also provides access to previously gated capital. So TVL, or total value locked, measures the total value of assets held in DeFi smart contracts and is a gauge for the size of the DeFi market. There's $150 billion of TVL at time of this writing, up from 90 billion in April of last year. And it was at 6 billion in August of 2020. That's how much DeFi has grown in the last just 2 years. Then we have NFTs, obviously a huge market right now. And they allow people to own things like art, photos, code, music, games, and virtual world objects, credentials, governance, access. The list goes on. It's kind of, NFTs are the Swiss Army knife of Web3. NFTs provide a novel new form of monetization for content creators. In the last year, there has been $56 billion worth of NFT sales. That is insane. Sales volume have declined to 0.8 billion per week since their January 2022 peak of 4 billion, but up significantly from early 2021 volumes of 5 to 30 million per week. Huge difference. That majority of NFT sales are digital art. By comparison, the traditional art market did 37 billion in sales in 2021, down from a peak of 50 billion in 2007. So NFTs is quickly going to surpass DAOs. This is the other big unlock here that's happening with blockchain. So decentralized autonomous organizations. So they facilitate new ways of organizing people to collaborate and achieve a shared goal. 2021 saw massive growth in DAOs, and today the value of all treasury assets on DAOs, so you can think of on DAOs balance sheets, totals $11 billion. You can think of that similar to the treasuries held in companies' balance sheets, right? But this is DAOs balance sheets, so community-owned companies, you can call it. And as we wrap up here, blockchains are just inherently valuable because they are decentralized, functional, composable, and have native economics. These unique features make them the most novel and fertile development environments. They will continue to spark innovative products and experiments. To cement the use case for blockchain security and scalability need to improve, and that will be a topic for another post, which is likely what we will talk about with Sam in our interview coming up in just a couple of days. We will talk about comparing some of the blockchains in this ecosystem and understanding the security and the scalability of these and sort of where this stuff is going. I think it's clear from this article here that I just read how valuable this stuff is, right? There are people all around the world that want to build businesses. They want to send money to their family back in another country. They want to transact. They want to interact. They want to do whatever it is they want to do in the internet. And finally, with blockchains, they have the ability to do this permissionlessly 24/7 whenever they want. There is no 9 to 5 hours like the banks have. There is no geo blocking or deplatforming. It is just open and permissionless. And of course, this is where innovation is going to go. Why would you ever build on a centralized network when you have the option to build on a decentralized network that is permissionless and composable and has all of these things we just talked about? Of course, this is where the innovation is going to go and entrepreneurs are going to build. Of course, right? It's so obvious. And so to me, Web3 is inevitable because it just makes sense. The incentives are there for everyone, the users, the developers, the entrepreneurs, literally everybody. And that to me is the really cool thing about what blockchains enable, because without blockchain, you can't have any of this. It's just not possible. So thank you, Sam, for writing this article and allowing us to share it with our Web3 Academy community. I hope all of you enjoyed this, and make sure you join our Discord so that you can have a chat with us. Sam is in there, and you can ask him some questions, ask the rest of us questions. We're all always chatting in there and just trying to learn and explore the forefront of Web3. So please join us in there. The link to the Discord is in the show notes. Finally, if you want to write for Web3 Academy and get your article in front of our audience, we would love to do that. So please shoot us a message on Discord, or just go to the application in the show notes and send us what you've written. And we'll take a look. And even if it's not great, we'll help you make it great. We have writers, and we will help improve. Don't be shy. We want to share what the minds of Web3, and especially those in Web3 Academy, are thinking. Okay. Thank you all so much for joining me today and listening, and I will see you all in the next episode. Thank you for listening to Web3 Academy. We hope this helps you along your Web3 journey. And if it does, please share this episode and subscribe so you don't miss the next one. By the way, if you've yet to join the Discord community, you are missing out. This is where all the magic happens. This is where we learn, where we ask questions, where we network. You want to be in there. The link to join is in the description below. And finally, a quick disclaimer. Nothing in this podcast was financial advice. Crypto and Web3 can be risky. You can literally lose it all. In fact, if you invest on account of what we say, you probably will lose it all. So don't do that. In all honesty, the point of this podcast is to remove the noise of markets and price and focus on utility and implementation anyway. So you should not take any of this as financial advice. Thank you, friends, and see you in the next one.